Ladies and gentlemen, brace yourselves for some jaw-dropping news in the stock market realm. Just when we thought Nvidia, the reigning titan of artificial intelligence chips, had only one way to go up, recent revelations have sent ripples through the investing world. Whispers of Nvidia's customer concentration issue have surfaced, catching many off guard. Was it Microsoft, Meta, Amazon, or maybe even Google? What does this mean for the future of one of the world's largest chip makers? Stay tuned as we dive into the details, unveil the key players, and explore the implications of this surprising development and how it will possibly affect Nvidia in the future. Hello everyone and welcome back to Investocracy.
What's happening in tech? We said that the NASDAQ's down more than 5% this week. We're having the worst week in about 18 months, and the tech sector itself is off more than 7% on the week. What's going on with that trade?
Tech, I think, revealed its hand last week because Nvidia had a good number, but it fell. So when stocks fall on good news, you know it's either a crowded trade or something bad could be coming. And then, of course, they led the downside this week. I think it is part of this pull forward the seasonality because people want to de-risk, and tech is a big holding. But I think on the margin, there could also be a political aspect to this. You know, Trump's probability of winning actually increased this week in the betting markets and in the polls. And I know investors think he'll be tough on China, which would be bad for semis. So I think part of this could be fears that a Trump gaining is bad for semis.
What if there's just too much priced into these stocks at this point? Valuations have gotten a little too rich, even if they're the greatest stocks in the world, which you've made the argument that, in fact, they are. That this is the place you want to be, maybe more than any other. And what if that's true and the multiples still don't make sense?
I think it's possible. In NVIDIA's last 10 years of history, there have been 30% drawdowns, almost 8 times of similar magnitude. Its PE, NVIDIA's forward PE, was actually higher at the bottom of those drawdowns. You know, right now, NVIDIA's forward PE is in the mid-20s. So to me, this looks like a normal profit taking. Maybe it takes NVIDIA down to the 90s, but I think 2 years from now, that's really going to be a gift.
So when you look at all of these, are you a buyer on the dip? Are you urging people who read your research and listen to you here and elsewhere to do that?
We're close to that point because let's say we thought that there would be a 7 to 10%, the risk of a 7 to 10% drawdown between now and November. We're almost down 5% now. I think next week we could be within that point of where we pulled forward that entire correction into the month of September. So I think we're close to the point where, I wouldn't be a seller here, and I think the lower range of the S&P's 5,400, 5,350, we're almost there now.
For anyone invested in the stock market or not sleeping under a rock somewhere, Nvidia has been a name synonymous with unparalleled growth. Over the past 5 years, the company has skyrocketed its revenue and free cash flow by nearly 900% and 800%, respectively. Holding an estimated 80% market share in the AI chip domain, Nvidia has seemed to be sitting comfortably on its throne. But every empire faces challenges, and for Nvidia, these challenges are now becoming more and more visible through its latest earnings report when put under the microscope by analysts and experts. And all eyes end up at the same place: customer concentration. But before we dive deep into the reasons why this is specifically important, you need to first understand the concept of customer concentration and how it relates to companies. Customer concentration is a metric that determines a business's revenue distribution across its client base. Fundamentally, it's a critical aspect for investors to consider. Imagine having a business where one customer contributes a significant chunk of the annual revenue. It puts the company in a vulnerable position if that customer suddenly had a change in mind and opted out. Not to mention, as an investor, if a company you are looking to invest in has this kind of structure going, you would think 1,000,000 times before investing. It is just a very volatile situation. This is the scenario Nvidia is currently dealing with. But before we go any further, if you want to keep up with Nvidia's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market. So click the follow button if you don't want to miss the newest market updates.
You tried to hedge a little bit heading into both Nvidia and Broadcom, right? Talk to me about the trades that you made going in.
Yes, Scott, I think we had a good thesis last week that Nvidia was going to be volatile. Option markets were indicating somewhere between a 9% move. You just never know if it's going to be up or down. It'd be a lot easier if you did. Same thing with Broadcom yesterday. pretty heavy indication of an 8-9% move. So what we did yesterday with Broadcom is we wrote a covered call, only a 1-week expiration, so it'll expire next Friday. But the annualized premium that we brought in was 60%. Now, I realize that sounds crazy, and it's only because of the hyper volatility heading into earnings, but we brought in $1.73 yesterday. We wrote a covered call on Broadcom, incidentally, when we did the Nvidia call last week. We brought in $1.25. So we closed that out yesterday, wrote another Broadcom call. It brings in about $3 in premium for the past 2 weeks. Now, granted, the stock's down a lot more, but we were able to hedge 20% of today's decline with those 2 option trades just within the past 2 weeks. So it worked out well for Nvidia. It's worked out well for Broadcom. The stocks are trending down, so I think we want to be a little bit patient before we add to them. But I think that you'll get a buying opportunity. And we're seeing prices, Scott, similar to where we did at the earnings, at the jobs report last month when we saw the massive sell-off. So I feel like that would be a good entry point for people to buy the dip for sure.
So you're more of in the buy this market rather than beware it.
Yeah, I would definitely. We didn't buy anything today. It was a short week. It's the first week where people are back after the holidays. You get a lot more volume, so we wanted things to settle out. We were also very concerned about what the jobs report would look like, remembering what happened last month. I thought the numbers were good on the jobs report. The market selling off, I think, is more of a growth issue than a recession issue. Whether the Fed's going to cut 25 basis points or 50, a lot of uncertainty in the market there. But I think the opportunities, Broadcom's already back to where it was on that August 5th, August 7th low. Nvidia isn't, but certainly it's getting closer. And yeah, I would be a buyer of the dip, Scott, and we will be.
In Nvidia's second quarter earnings report of fiscal year 2025, it was revealed that 46% of their total revenue stemmed from just 4 customers. Yes, you heard that right. Almost half of Nvidia's $30 billion in quarterly revenue originates from a mere quartet. Comparatively, during the first quarter ending April the 28th, the company noted that 24% of total revenue was contributed by 2 direct customers, and 2 indirect customers each accounted for at least 10% of revenue. Historically, this concentration is not something new for Nvidia. In its fiscal year 2024 report, 1 customer was responsible for 13% of total revenue. In fact, another indirect customer, purchasing via one of Nvidia's largest direct clients, accounted for approximately 19% of the company's annual earnings. To put this into perspective, Nvidia had no customers accounting for 10% or more of the total revenue during fiscal years 2023 or 2022. The surge in demand over the past year or so seems concentrated among a very limited number of high-profile clients. This brings us to a crucial question. Should investors be worried about Nvidia's increasing client concentration? And if the concentration is as it was reported to be other big tech companies like Meta and Tesla, should investors worry about them possibly pulling out and being competitors themselves? But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Lucas, welcome back. Is there still more to sell in AI?
Oh, absolutely. I mean, this is just getting started.
Oh boy.
I can't predict what's going to happen in the next 5-6 days. I think, as one of your previous guests mentioned, it's entirely possible that we have some sell-side analysts come out, defend the sector. We get some slightly better news from some company here and there, and we get a rally back up to, all-time highs or close to that. But the fundamental case hasn't even began to turn down, and I think there's a lot of froth in the space that will come out over the next 24 months.
While having elite names such as Microsoft, Meta, Amazon, and Google as supposed customers sounds incredibly promising, there's a flip side to this shiny coin. Tech analyst Gil Luria from D.A. Davidson has speculated that these are likely the major clients contributing to Nvidia's concentrated revenue. Luria emphasizes that such dependence is unusual for a company as vast as Nvidia and advises investors to heed this trend over the next couple of years. Consider the potential risks. Tesla's Elon Musk has hinted at the company venturing into the AI chip industry themselves. Meta, led by Mark Zuckerberg, is already working on its own chip, the Meta Training and Inference Accelerator, to cut dependency on Nvidia. Similarly, Amazon has doubled its efforts to develop in-house AI chips. Even though Nvidia still reigns supreme with its high-demand H100 graphic processing unit GPU, The looming threat of these tech giants moving towards self-sufficiency cannot be overlooked. The potential competition from these tech behemoths might not topple Nvidia, but could certainly dent its pricing power and profit margins, reducing its once formidable growth trajectory. Let's back this analysis up with some data. Nvidia reported $30 billion in revenue for the second quarter, with nearly half, approximately $13.8 billion, coming from 4 primary customers. Though the company's reliance on these big names has raised eyebrows, Nvidia is still a force to be reckoned with. Even so, they recently experienced a colossal $279 billion loss in market value, which has undoubtedly spurred concerns. This decline followed their quarterly financial disclosures, which have injected a dose of volatility into Nvidia's stock price that continues a downward spiral to this day. Interestingly, despite Nvidia's dominance in the AI sector, less than half of the ultra-wealthy members of Tiger 21 consider it a favorable investment. Furthermore, uncertainty surrounding product releases, like the anticipated Blackwell GPUs, has stirred investor sentiment. That said, back to the video.
Because I think it's becoming clear to investors that you're spending a ton of money on AI, and despite what people say, the facts are that even though spending on AI is going up, your revenue forecasts are going down. And what I mean by that is if you look at the 3 biggest hyperscalers and 3 of the biggest stocks in the S&P 500, which is Microsoft, Google, and Amazon, all 3 of those companies, when they reported their quarters, even though they upped the amount that they were going to be spending on AI infrastructure, the forward revenue figures for all 3 of those went down. So at a certain point, John, you're spending a lot of money, but you're going to want to see a return. And by the way, we saw this already post-COVID, where if you remember during COVID, and NVIDIA is going to come up, so I might as well bring it up. NVIDIA went from negative year-over-year revenue growth before COVID. COVID hit. Revenue growth then in early 2022 went to up over 80% year over year. Then, as you probably remember, there was this COVID hangover. Demand started to slow down. Those 3 big hyperscalers started to slow their spending, and NVIDIA's revenues by the end of 2022 went from up over 80% to down over 20%. And the stock went down 66% as you went through that digestion phase.
So, should you consider investing in Nvidia despite these alarming trends? The answer is complicated. Nvidia does remain a powerhouse in the AI chip industry, dominating with its innovative technology and substantial market share. Their revenue might currently hinge on a few key customers, but let's not forget their track record of strategic pivots and groundbreaking innovations. The current state of Nvidia's stock might seem unsettling, yet this very volatility presents an investment opportunity. Analysts project steady growth, albeit at a slower pace than before. Trading at $30 billion revenue in the latest quarter, Nvidia's market position is rock solid. In conclusion, while Nvidia's dependency on a few tech giants raises valid concerns, it also underscores the strong demand for its technological supremacy. At the end of the day, it all relies on your own judgment. What's your take on Nvidia's future? Could this customer concentration spell trouble, or will Nvidia navigate through with resilience? Let's discuss in the comments below. And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.